So we have seen a flurry of IPOs, and me and Amit were just talking about, how well they have been received by the street. What are you making of this sort of exuberance that we are seeing in the primary market?
Thank you, Suyash, and morning to all of you all. This only shows that there is ample liquidity in the market, both secondary, primary, and otherwise. Remember those days when even two or three IPOs used to hit the market with a decent amount of issue size. There used to be a fear that there will be liquidity sucked out of the secondary market and pumped into the primary market. But over the last couple of years, not only about 10 days back or 2 weeks back when these five IPOs hit the market, but even before that, there have been instances where a couple of IPOs have hit the market and the secondary market has been intact. And there has been tremendous amount of exuberance in terms of investors' attraction towards this IPO. And those IPOs have got subscribed multiple times. So the fact of the matter is a couple of things. One is that you should have a decent business when you go and hit the street for IPO. Second is your management should be capable enough to take that business forward. Third and the most important thing is the valuation. If you value or if your financial advisors advises you appropriately and if you price the issue at an appropriate level and you leave something on the table for the investors, I'm talking about investors, I'm not talking about gray market or listing guys,
Right.
listing profit kind of investors. Definitely those IPOs will attract a lot of subscription. So a lot will depend. I mean, we are talking about this couple of weeks back. Hanosa hit the street. Valuation was rich. Stock got listed marginally at a premium, and that was 10% lower circuit, and then the stock appreciated because of the fair valuation.
Right.
So you should have these things in mind before you subscribe for the IPO.
Good morning, Gaurang. We took into account just the top five: Flair Writing, Tata Technologies, Irida, Gandhar Oil, and Fedbank. Now, for the investors who are not able to get subscription in the IPO, which of these, according to you, should they look at the time of listing to invest into?
So let me say this. In terms of business and valuation, all five of them were fairly priced. One or two of them were attractively priced. So out of these five, we had two recommendations for the IPO as a subscription note. And that was, of course, Tata Tech and Irida. These two, we had come out with a IPO note and we had subscribed recommendation. Now, I don't know at what level the listing is going to be of these two names. Definitely going by whatever your commentary and assumptions of the gray market prices, Tata Tech would be one of the most attractive in terms of listing gains, and then followed by the rest. So those who have missed out or who wanted more number of shares, but given the lot size, if you're not satisfied and if you have appetite for more, I would only say that let the listing euphoria settle down and let some sanity come in. Going and buying at listing at a premium of whatever it is on the higher side may end up, possibly you investing at a higher level. So let the dust settle down, give it a day or two, and then possibly decide whether you want to invest or not.
Now, Gaurang, given the increased retail participation, SEBI over the weekend also came out and said that they'll perhaps, check the rules for higher valuation or the valuation premiums that these companies are coming out with. What do you make of these comments? Was this the need of the hour to protect the interests of retail investors?
See, Suyash, the most important aspect about having any kind of regulation is in place is having the investors' interest at paramount or at pinnacle of everything else. Because if you lose investors' trust, then you lose everything. So I think SEBI, not only now, but SEBI has been doing it over a period of time in terms of regulating, bringing in discipline. We all know what over-the-counter, exchanges do and what kind of stories we heard recently in terms of certain, routing of money or whatever be it. So my sense is that first of all, it is the obligation and responsibility of the financial advisor to advise the promoters appropriately in terms of fair valuation. If they do their job right, Suyash, I don't think any other regulator would want to step in. But if
Right.
if the regulator finds something amiss, then they will definitely step in and bring in that kind of regulation to possibly discipline the market and investors having a long-lasting faith in this asset class as an investment idea.
Now, Gaurang, we have lots of cues this week. You know, the exit polls, state assembly exit polls come out on Thursday, that's November 30th. Results are on December 3, Sunday. Then we have Mr. Powell speaking on Friday as well. We have, OPEC plus production cut decision also coming out on Thursday. So, among all these cues, which is the one that you are closely tracking and perhaps investors should play a close eye to?
And before that, you will have the FNO expiry also,
Oh,
Suyash,
right.
30th
Yes,
Thursday.
yes.
So you will have choppiness, volatility. We are possibly trading at closer to the higher end of the range that we discussed last week of 19,400, 500 on the lower side, 19,850 on the higher side. So as of now, we are trading closer to that higher range. And even last week, we tried to cross this over 19,875 was the high, if I'm not mistaken, and if I remember right, but we were not able to sustain. So given these events of news flows, one that I would possibly look at is the event on 4th of December with respect to the outcome of the state elections, 5 state election, because as we all hear, this is a semi-final before the big final next year.
Right.
Mr. Powell and OPEC Plus, I think this will be more of, digested as the news flows come. But FNO expiry, rollover numbers, and the outcome of 5 state election, I think I would be keenly watching these news flows.
Now, Gaurang, do you expect any sort of a major correction if there is not continuity in regime? Because this is a Hindi-speaking heartland, so perhaps market will be taking the beat for the general elections, a big one next year.
Our unfortunate thing about our democracy is that we have elections 365 days all around the year, somewhere or the other. And we have to react to it. But
Right.
I think if the result is not as per, or if it is absolutely thin in terms of no clear-cut majority coming through or a coalition kind of a government, maybe market will react knee-jerk the way it has reacted for the other state elections that we've seen this year and the outcome of that. So we will possibly have a knee-jerk reaction, but I would say that whatever be it, if you get a correction on fallback of any of these news flows and events which are lined up, like always, Suyash, it's going to be a great opportunity to nibble into some stock-specific ideas from a long-term point of view.
Gaurang, on this bulletin, we talk about fresh investors and how giving them advice on how they should start their portfolios. I want to pick your brains on people, say close to my age, who are around touching 50, who have a portfolio of a score or few score of lakhs. Is it time for them to reallocate portfolios, or how is it that they should approach the stock market at this age, the 50 plus age group of people?
So as you grow older, your risk appetite comes down. And if your risk appetite comes down, you need to really introspect, because when you come to equity markets in whichever form, either direct or via mutual fund SIPs or via lump sum investment, you are exposing yourself to a little bit of higher risk, because stock markets is all about high risk, high return. But if you're willing to take that, and if you have that appetite for high risk, first of all, if you don't understand the stock market, don't venture into it directly. Go via mutual fund. I think leave it to the fund manager to decide where he or she wants to invest on your behalf. Second, if you have enough time and if you are willing to do a little bit of in-depth study before you decide where to invest, then I think direct investment is a good option. Not that it is a bad option. But at the same time, you need to be careful about where you're investing. If you ask me sectorially, as of now, given the second earnings backdrop and the growth outlook going forward, I think banking, NBFCs, defense, power generation, power transmission, railway related stocks, autos, cement, and possibly IT as a contra bet. I would pick these 5 or 6 sectors, and my advice to all those 50 plus investors would be don't venture out into broader markets. Stick to the discipline of first picking up large caps, then selectively moving on to mid caps. Small cap and micro cap is absolutely no.
Gaurang, what about investors who 25 years ago when they were young, the 50 plus, did invest in, put their money into blue chip stocks which they have been holding on to for over about 20-25 years? Is it time for them to reallocate or just hold on to it for retirement time?
See, when you bought stocks 20-25 years back, you bought it at a damn cheap or lower valuation. Now, after 20-25 years, if you want to churn that portfolio, remember one thing, whatever you buy, you will be buying at current valuation, which may turn out to be expensive. And unless and until, I say one thing very simple, that if you bought quality stocks, unless and until you need money, stay invested. And those quality stocks, if you really don't need that money, then pass it on to the next generation as a gift and give them a learning, a lesson or an understanding how stock market has created wealth for you, so that they also get attracted towards equity market as a disciplined investor, not as an uninformed trader. So unless you need money, don't liquidate. If you have more to invest, then I think the 5-6 themes sectorially that I have put in front of you should be the preferred destination.
Sir, before we let you go, insurance stocks stole the limelight in Friday straight, and the kind of rally that we have seen in the last 15-20 days, where they have, GIC, LIC and National India Assurance have rallied by about 35 to 40% or so. However, they are still significantly below their respective IPO price, and the valuations are also looking reasonable. So perhaps is this the space that one can look at?
So I'll split into two. One is your life insurance business. One is general non-life. In general non-life, we have a positive coverage on ICICI Lombard. In the life insurance space, we have coverage on all the leading names, starting with LIC, moving on to SBI Life, then going on to HDFC Life, and then ICICI Pru. And we've discussed this particular sector earlier also, Suyash, if I recollect right. And I have always maintained that if you're looking at investment into life insurance related companies, then your time horizon has to be 1.5, 2 year plus, because it will take that kind of time horizon to bring in new insurance premiums, which will increase the run rate. Because now people who are buying insurance, they are buying of a higher sum assured, and by the virtue of that higher sum assured, you and me have to pay higher premiums, which turns out to be a better premium run rate and income for the life insurance companies. So we remain positive on all these names, provided you have 1.5, 2 year plus kind of a time horizon.
Words of wisdom coming from Mr. Gaurang Shah. Sir, always a pleasure speaking to you. Thank you for joining us here on First Sec.